On October 1st, 1985, weeks after the Lynx Club Accord that sprung Schwarzman from Shearson, Peterson and Schwarzman formally launched the Blackstone Group, with Peterson as chairman and Schwarzman as CEO. The name, Schwarzman's invention, reflected their ethnic roots, combining the English equivalents of Schwarz, German and Yiddish for black, and Peter, Greek for stone. They opened an office on the 34th floor of the Citigroup building, the elegant Mies van der Rohe and Philip Johnson designed skyscraper on Park Avenue just north of Grand Central Station. Their quarters were conspicuously austere, just 3,067 square feet, which they outfitted with 2 desks and a used conference table. There was one other employee, Peterson's secretary. The funding was similarly frugal, $400,000, half from each partner, to pay Blackstone's bills until cash started coming in. That was nothing to Peterson, who had pocketed more than $13 million in severance pay, and from his cut of the money from Lehman's share to Shearson. Schwarzman, too, had made a bundle, $6.5 million, from the sale of his Lehman shares. But though the amount they staked to Blackstone was comparatively small, they were determined not to risk any more. They worried that if they ran through the money before Blackstone started to pay for itself, it would bode ill for their venture. It was the same cautious approach to risking money that would become a hallmark of Blackstone's investing style, and helps explain why Blackstone avoided the kind of brazen, outsized gambles that caused some high-flying rivals to run aground. Schwarzman and Peterson had a breakfast ritual, convening at 8:30 nearly every morning in the cafeteria of the former Mayfair Hotel on 65th Street and Park Avenue, now the site of the celebrated restaurant Daniel. There they mapped out their plans for a hybrid business, part M&A boutique, part buyout shop. They had no wish to emulate investment banks or brokerage firms, which need sturdy capital foundations to back the commitments they make to their clients and to tide them through when they lose money in the markets. We didn't want to have a lot of capital tied up in low-margin businesses, Schwarzman says. We wanted to be in business where we could either drive very high assets per employee or operate with very high margins. Giving M&A advice was the ultimate high-margin work, enormous fees with very little overhead. Managing a buyout fund was appealing because a relatively small team could oversee a large amount of money and collect a commensurately large management fee along with a share of the profits on the investments. They also hoped to tack on related businesses that made their money from fees. They weren't sure yet what those would be, but they thought they could attract like-minded entrepreneurial types from other niches of the financial world who could benefit from a collaboration. They lacked the dollars to hire top talent, however, or to stake another business. Nor did they want to share the ownership of Blackstone. The memory of the feuding at Lehman was still all too fresh, and they wanted absolute control of their business.